Hello there, I hope that you're doing well. Welcome to this new lecture. During this lecture, I'll be teaching you how to find low risk, high reward setups using market maker models and time cycles. Now, before we dive into this lecture, I want to share with you that market maker models and time cycles are the core behind algorithmic price delivery. Now, I understand that might sound complicated to some of you. However, I promise that by the end of this lecture, you will have gotten a great understanding of both market maker models as time cycles and their importance on the delivery of price. Now, when we pay attention to the following schematic, what I would like to see is that I've outlined the PD array matrix in front of you. However, what you can see me have written down is that all PD arrays mean nothing without. And I'm about to share with you what has to be understood prior to you even considering looking at PD arrays. The reason why this is so important to understand is because the majority of traders that get into the world of algorithmic price delivery, they begin to look at PD arrays and they begin to trade purely because of a PD array which presents itself. I know that you're probably listening to me speak and you're probably like, damn, you just nailed me right there. Yes, I know. And the reason why I know this is because I did it as well. I went out there at first as well when I got introduced to ICS concepts and thought to myself, oh, all I need to look for is this pattern in price, this bullish breaker formation, and I found myself a trade. Well, let me ask you something. How do you know what bullish breaker is going to work? Or how do you know what bullish fair value gap is going to support price? How do you know from what moment in time those discount arrays are going to function as support on price? Or how do you know from what moment in time that bearish breaker is going to function as resistance on price? Or how do you know that the bearish fair value gap is going to function as resistance on price? That right there was the main question I asked myself when I began studying ICS concepts. However, by investigating deeper, I began to realize that the PD arrays themselves are simply a way of gauging order flow. And because they are simply a way of gauging order flow, it means that there are other principles which must be looked at prior to even considering PD arrays. And what those principles are going to be discussed during this lecture. So all I ask of you is a little bit of your time, because I promise that by the end of this lecture, you will have no questions ever again about why price is doing what it's doing, and most importantly, when it's doing what it's doing. First of all, what I would like you to understand is that the reason why PD arrays work is due to the following. They only work when price is clearly in a move from an inception level to a terminus level, A to B. If we know very clearly what the current price swing is from A to B, we can look for the corresponding arrays to function as either resistance or support on price. However, if you're unable to clearly define what the current price swing is from A to B, you can be using all the PD arrays you want, but you're not going to be achieving the consistency which you're looking for. Therefore, your focus has to be right now on being able to recognize inception to terminus. Once you're able to recognize what inception to terminus is, only then can you consider looking for entry patterns. So during this lecture, our focus is going to be on recognizing inception to terminus A to B. By the end of this lecture, you have experienced multiple light bulb moments, and that's a guarantee. And there's absolutely no way that you're going to watch this lecture and think to yourself, oh, this right here doesn't make any sense, because I'm going to literally lay everything right in front of you, which you need to understand in order to be able to look at the markets through the lens that I'm looking at them. Now, when it comes to market maker models, what I would like you to understand is that market maker models are simply a framework through which we're looking at price action. Market maker models provide structure behind what price is doing right now. In front of you, you can see the market maker sell model, and the market maker sell model looks like the following. Where you can see that there's an original consolidation down here, the market expands higher, it retraces, and it expands towards the upside once more before eventually reversing. This is what we refer to as the left side of the curve. And what's important to note is that the moment that we see this left side of the curve being developed, that is a buy program which is taking place. In a buy program, what's happening is that IPTA is drawing towards buy side liquidity. It's drawing towards old highs. The moment that it, however, reaches our point of interest where we can anticipate the reversal to take place from, that is when we can look for that buy program to change into a sell program. And what happens there is that the buy side of the curve turns into the sell side of the curve. You can already anticipate this coming by recognizing this original consolidation, because this original consolidation sets up the creation of the market maker sell model. When you recognize that price is consolidating very cleanly during a specific window of time and price then begins to run towards the upside, that should immediately be a sign to you of, hey, this is something to monitor. And the reason being is because retail-minded traders are looking at this original consolidation through the lens of, hey, we reached a strong support level, so we should be market buying right now. The fact that those clean relative weak lows get created shows to them, hey, price has reached a strong support level, my stop should be placed below that low, and as the market expands towards the upside, they seem to believe that their idea gets confirmed. However, this is exactly what IPTA is programmed to do, where it leaves these smooth levels intact, where you can see that every single retail-minded trader is being trapped into believing a false idea. The fact that price then expands towards the upside confirms this to them. However, this is all manipulation taking place so that distribution can take place afterwards. So the moment that price changes from buy to sell program, what you can anticipate is that we're likely going to see the market draw towards that original consolidation, towards that engineered sell side liquidity. And once you become good at recognizing this framework within the markets, you are going to be able to anticipate inception, which occurs right here inside of the smart money reversal, to terminus. What is terminus? Terminus is the low of the original consolidation. That's the draw on liquidity, so to say. It's important to note that what you see in front of you is not a pattern within price action. Market maker models are no patterns that you can simply look for and boom, there you go. No. These are frameworks to which we're looking at the markets. There are very specific elements within price that we look at to confirm that the market maker model is in fact in play, and during this lecture I'll be showing them to you. When we pay attention to the opposing schematic then, what I would like to see is that this schematic is the schematic of the market maker buy model, and it's exactly the same as the market maker sell model, but purely inversed. Where you can see that we have an original consolidation right here, where price is going sideways and is creating these smooth highs. Price expands towards the downside, retraces higher, and has one more expansion towards the downside. Now it's important to note that on the left side of the curve right here, there can be and usually will be multiple expansions, retracements, expansions. However, for the simplicity of this schematic and this lecture, I've decided to just keep it at one. But the moment that price expands towards the downside like this, retail-minded traders are looking at that as a strong bearish market. They see these highs right here and they think we reached a strong resistance level, so price is now going to expand towards the downside, towards the support level, so to say. However, what is important to note is that what is being engineered right here is buy-side liquidity. Retail-minded traders will look to go short and they will look to place their buy stops above the highs which are forming on the left side of the curve. The moment that price eventually reaches our point of interest and we begin to see the signs of a reversal taking place, that is when we can anticipate prices changing from the sell side of the curve to the buy side of the curve. Why? Because what IPTA will spool towards is engineered buy side liquidity above these smooth highs right here. Therefore, our focus has to be on recognizing that this leg lower is to be manipulation, because after that manipulation ends, distribution will unfold. And that is how you can see when you take this and view this on a bigger scale, how you can, for example, see that when it comes to these mega trades, that the news gets utilized to trap everyone into believing that lower prices are next. Fear gets induced. A lot of fear gets thrown around across the media, across social media, etc. But it's exactly in that realization and awareness that you must be able to look at that objectively and think to yourself, why oh why is all of this coming out right now whilst the market is reaching a point of interest? What that signals is that everyone is being trapped into believing a false belief, so that IPTA is going to eventually reverse and spool towards all of the liquidity which it has engineered throughout that period of time. These are market maker models. And market maker models lay at the core of algorithmic price delivery through the lens of price. This has nothing to do with time. Market maker models are purely price and they're not patterns. However, during this lecture, I'll be teaching you how to recognize where market maker models begin, but also where they're likely going to end. This is inception to terminus, and that is what our focus is going to be on. Do you notice how so far throughout this lecture, I haven't even mentioned any PD array? Do you now understand why it's so annoying for me to see all these traders go online on social media and speak about, oh, this is the entry pattern, this is the strongest pattern, this is the PD array to use, whatsoever, but it doesn't matter. I don't care about whatever PD array I use to enter. I can literally press market buy the moment that I know the smart money reversal is in. Why? Because I've trained myself to recognize inception to terminus, inception of a new price swing, and once price reaches my draw liquidity, that's when I anticipate the price swing to end. And that is what our focus has to be on. Now, when we pay attention to the lens of time cycles then, I'm going to be showing the understanding of time cycles to you through, first of all, the weekly delivery. And the reason being is because I know that the majority of people that will be watching this lecture are likely focused on the lower time frames. You're likely focused on trading intraday. And because you're focused on trading intraday, it's important that you begin to pay attention to weekly delivery at first. And the reason being is because by paying attention to the weekly delivery, you're able to see very clearly where price is drawn towards. When it comes to weekly delivery through the lens of time cycles, I would like you to understand that Monday sets the stage for Tuesday. Tuesday sets the stage for Wednesday. Wednesday sets the stage for Thursday. And Thursday sets the stage for Friday. And what's important to note is that when it comes to these days, it's important to note that throughout each new day, we refer to the previous day, its respective high and low. And the reason being is because by paying attention to the reactions to those levels, we can gauge the order flow. We can anticipate whether or not price is now in a buy or sell program. So by being able to recognize if price is now drawn towards, for example, a previous day high, and we displace through that previous day high and begin to use it as support on price, that would be a sign of bullishness. If, however, we would see the market reject the previous day high, and we see the market show the signs of forming a reversal, then that would signal that we likely manipulated above the previous day high to draw towards engineered sell-side liquidity next. So pay attention to daily delivery through the lens of paying attention to what the previous day did to anticipate what the next day is likely going to do. Another example of this is, for example, if, let's say, Tuesday expands higher significantly and we see a very large range get established, what is likely going to occur on Wednesday? Are we likely going to see another large range be established, or are we likely going to see a small range get established? The latter is right, and the reason why is because after a large range has been established, there will always be a small range. Why? Because new liquidity will have to be engineered. Price just can't keep expanding forever. At one moment in time, price must retrace to engineer new liquidity above the retracement high before it can continue expanding. This is a very important concept to understand because now we're looking at weekly delivery, but I'm going to show to you that the same logic applies on smaller time cycles. Meaning, instead of paying attention to weekly delivery, we're now going to be paying attention to daily delivery. When it comes to daily delivery, I have very specific windows of time, which are in New York time. Yes, this is very important to note. New York time has to be the time on your TradingView charts. And the reason being is because IBDA runs on New York time. And therefore make sure that all your charts are set to New York time. And the times which I'm discussing right now with you are all in New York time. But when it comes to daily delivery, I have 4 different sessions which I'm looking at. First of all, I pay attention to the Asia session. Asia sets the stage for the new day. The second session which I'm going to be paying attention to is the London session. And the third session I'm going to be paying attention to is the morning session. And the fourth session I'm paying attention to is the afternoon session. When it comes to daily delivery, it's important to note that I'm looking at daily delivery through these 4 different sessions. And each session sets the stage for the next session. And throughout each new session, we refer back to what the previous session did to anticipate what the current session is likely going to do. When it comes to the timings of these sessions, what I would like to understand is that Asia begins at 6 p.m. and lasts all the way until 2:30 a.m. The London session then begins at 2:30 a.m. and lasts all the way until 7 a.m. The New York morning session then begins at 7 a.m. and ends at 11:30 a.m. And the New York afternoon session begins at 11:30 a.m. and ends at 4 p.m. When it comes to these different sessions, we pay attention to their respective highs and lows to gauge the order flow throughout the day. When we then zoom into the sessions, we're going to be looking at the London session. And you might be wondering, why do we look at the London session and why don't we look at the Asia session? Well, in my opinion, the Asia session is not a session that you should look to trade. It's possible, don't get me wrong, and you can be applying the same concepts as I'm teaching to them. However, I would like to ask you something. If you have the flexibility to choose your own sessions, why would you trade a session which is less favorable than the main sessions? Meaning, the main sessions for the index futures are the New York morning and New York afternoon session. However, I know that some people can only trade London, and therefore I'm going to be showing London to you as well, because for London there are specific things which we can be paying attention to. But in my opinion, your focus has to be on the sessions which are likely going to provide the majority of the daily move, the majority of the daily range. When we pay attention to the London session, what I do is I divide this London session in 3 90-minute cycles. And the reason being is because by paying attention to 90-minute cycles, what I'm doing is I'm structuring my perspective on the markets. Meaning, I'm structuring literally, okay, this is happening within this window of time, and this is likely going to happen throughout that next window of time. When we pay attention to the London session, 2 90-minute cycles, it begins at 2:30 a.m. From 2:30 to 4 a.m., we have our first 90-minute cycle of the London session. This 90-minute cycle sets the stage for the next 90-minute cycle from 4 to 5:30 a.m. The third 90-minute cycle begins at 5:30 a.m. and lasts until 7 a.m. Now, just like I've outlined within the weekly and daily delivery, throughout the London session, the same concept applies. By paying attention to the current time cycle, we're able to anticipate what the next time cycle is likely going to do. And throughout that next time cycle, we're going to be paying attention to the previous cycle, its respective high and low, to gauge the order flow. The reason being is because throughout these windows of time, a high and low will form. These are objective levels. And that means that they are already shown to you the moment that the new cycle opens up. All you have to do is pay attention to, okay, where did the high and low of the previous cycle form, extend them to the right, and then monitor the reactions to those levels. And I promise you that if you start doing this, you're going to be looking at these charts like, how the hell did I not spot that prior? It's because it's hidden in plain sight. And that is what I'm showing to you now. And notice that I haven't even showed a chart to you. And the reason being is because this logic gets understood by looking simply at theory. By looking simply at a flowchart and thinking to yourself, okay, why does this work this way? Think about it. Look, if within a specific window of time, key liquidity pools are being established, and the next time cycle manipulates above, for example, that previous cycle high, and it shows the signs of reversal taking place whilst you're already anticipating lower prices for the session and day, then you already know, hey, price is manipulating higher now to distribute towards the downside. When we then pay attention to the New York morning session, it's important to note that it begins at 7 a.m. and it ends at 11:30 a.m. This window of time can be split into 3 90-minute cycles, with the first 90-minute cycle beginning at 7 a.m. and ending at 8:30 a.m. This is referred to as AM1. The second 90-minute cycle begins at 8:30 a.m. and ends at 10 a.m. This is AM2. And the third 90-minute cycle begins at 10 a.m. and ends at 11:30 a.m. This is AM3. And what's important to note is that each cycle sets the stage for the next time cycle, its delivery. So pay attention to what the current cycle is doing to anticipate what the next cycle is going to do. And when that new cycle begins, paying attention to the previous high and low is going to give you a great insight when it comes to where key liquidity pools are, which have to be monitored moving forward. Now, when it comes to the New York morning session, there are very specific delivery profiles which we can be paying attention to according to the news which is scheduled for that day. If you would like to investigate these delivery profiles, I highly recommend you to check out our free economic calendar called Traders Feed. Traders Feed is the economic calendar which we have been developing over the course of these past couple of months, and what we do is we pair, based upon the news which is scheduled for the day, we pair that with anticipating when manipulation is likely going to occur and when distribution is going to occur. And whenever we can recognize when the manipulation is taking place as outlined prior, we can anticipate when distribution is likely going to occur. And for each different session, there are specific delivery profiles which you can be paying attention to. Now, you can go to the description underneath this lecture and you can make an account for free on Traders Feed, and you can be researching this right here in pairing with the time cycles and the market maker models as I'm teaching them to you today. Now, when we pay attention to the afternoon session then, and we pay attention to it through the lens of 90-minute cycles, once again, what I would like you to understand is that the first 90-minute cycle begins at 11:30 a.m. and lasts all the way until 1 p.m. This is what I refer to as the lunch cycle. The second 90-minute cycle for the afternoon session begins at 1 p.m. and ends at 2:30 p.m. The third 90-minute cycle begins at 2:30 p.m. and ends at 4 p.m. And when it comes to these time cycles, just like we've discussed prior throughout this lecture, it's important to note that each cycle sets the stage for the next time cycle. Throughout each new time cycle, we pay attention to the previous cycle, its respective high and low, to monitor the reactions to those key liquidity pools. When it comes to the afternoon session, there are also specific delivery profiles which you can be paying attention to. Once we recognize what delivery profile is in play for that specific session, we can anticipate when distribution is going to occur after we confirm that the manipulation is in play. This is how I want you to start thinking about time cycles. Time cycles can be looked at through the lens of purge and revert. There's also another possibility, and that is when continuations take place. However, for the topic of this discussion, which is finding low risk, high reward setups, this is all that we're focused on. Finding a purge of a previous cycle, its respective high or low, respective to the anticipated daily order flow for that day, and then looking for the signs of reversal taking place, which signal to us that price is now changing from either sell to buy program or buy to sell program, so that we can anticipate that price is going to draw towards the opposing side of liquidity. Now, when it comes to this purge and revert framework, which I'm outlining to you right here, what's important to note is that a purge and revert is a purge of a previous cycle, its respective high or low, once that new time cycle opens. So if we are looking at a bullish example, what you can see is that a new time cycle opens up right here, drops lower, taking out the previous cycle low, which is represented by this red line right here. And we then see the market reverse, drawing towards the previous cycle high, which is shown by this green line right here. If we pay attention to a bearish example, what we can see is that a new time cycle opens up, manipulates higher, taking out the previous cycle high, and reverts towards the previous cycle low then. This is a bearish purge and revert. Now, you can look for this inside of bearish markets. You can look for the opposing inside of bullish markets. However, if you want to take it one step further, you can even say, hey, instead of purely looking at bullish or bearish days, you can also be looking at bullish or bearish sessions. And you can also be looking at bullish or bearish 90-minute cycles, because within the 90-minute cycles, there are also smaller time cycles, 30, 10-minute cycles. However, for the majority of traders which are going to be watching this lecture, your focus is likely going to be on capturing one trade and then be content with that. The reason being is because if you dive lower than 90-minute cycles and you begin paying attention to 30-minute cycles, you're beginning to look a lot at scalping. And scalping is something which I excel at. I love to do it. However, it's hard to do, and therefore it takes a lot of experience to be able to do so. And it's not simple. What I'm outlining to you today is a very simple approach to looking at the markets based on time and price. And again, we haven't even touched on any PD arrays yet, because we're simply establishing the frameworks for which we're looking at the markets. And once you're able to recognize what the inception to terminus is, when you can recognize a purge and revert, only then can you consider looking at PD arrays to confirm change in the state of delivery, to confirm that price is now going to expand a specific way, where entry opportunities will present itself, etc. Now, when it comes to confirming reversals, there are a few things which I would like to pay attention to. Those are the following. In front of you, you can see both a bearish reversal as a bullish reversal. Now, what's important to note is that you can see two highly correlated markets be next to each other right here. These highly correlated markets should always move in tandem with each other. However, what you can see is that they didn't inside the reversal. If we pay attention to the bearish example at first, what I would like to see is that market 1 created a high, retraced, and then had one more push higher to create a higher high. Market 2, however, created a lower high right here. And the reason why this lower high is so important, which is being established, is because this shows that there is a Kraken correlation which is taking place between market 1 and market 2. When this Kraken correlation is taking place at a point of interest where we're anticipating reversal to take place from, at, for example, a previous cycle high, then we can anticipate likely that price is going to begin expanding towards the downside soon. What confirms to us that price in fact begins to change from buy to sell program and that we're going to see an expansion lower taking place is the following. The moment that price displaces below the low, which set up that final run higher, which set up SMT, meaning this low right here got displaced through. The moment that that low gets displaced through, that is to us the sign that following is taking place. That's the sign that we're changing from buy to sell program. It's the confirmation that we're in fact rolling over, so to say. What you can look at from a PD array perspective is for the final down close candle which formed inside of this low formation to be a bearish breaker inside of the market 1 and a bearish mitigation block inside of market 2. And that is the beginning of the sell program taking place right there. But keep in mind that this right here can only be looked at once everything else has been defined prior and you're anticipating that performing a swing high soon. How do you anticipate this? By recognizing manipulation, because once you recognize manipulation and this fractal presents itself, that's a confirmation that we can now anticipate distribution to unfold prior. Now, when it comes to the bullish example then, what I would like you to understand is that the bullish example is exactly the same as the bearish example, but then inversed. And the reason this is the case is due to the following. What's important to note is that the same reversal sequence presents itself on the downside as it does on the upside. It's constantly the same process which is being repeated by these high frequency trading algorithms. Our job is to recognize what the sequence is that is currently being followed, and once we recognize what that sequence is, we can then anticipate with a high degree of confidence what's likely going to happen next. We recognize, for example, let's say step 1 to 6, so therefore we know that step 7 will have to follow as a natural byproduct of that. Now, when it comes to this bullish reversal, what you can see is that market 1 right here expands towards the downside, forms a low, retraces higher, and then has one more push lower, creating a lower low before eventually expanding towards the upside. If we pay attention to market 2, however, what I would like to see is that market 2 also expands towards the downside, retraces higher, and has one more push lower, but it doesn't create a lower low relative to this first low. It creates a higher low instead. So what that means is that there's a Kraken correlation which is being established between market 1 and market 2. This Kraken correlation sets up the reversal taking place afterwards. The moment that price displaces above this high which set up the SMT, we can say with a high degree of confidence, hey, price is changing from sell to buy program after we're already anticipating that manipulation is now taking place. Because once we see the confirmation of this manipulation coming to an end, that is when we can anticipate distribution to unfold afterwards. Now, one thing which is important to note right here is that I know that some of you are going to be watching this lecture and you're going to be looking at this schematic and you're going to be just going into the charts and purely looking for this. If you do that, you're doing it wrong. And I know I said that quite bluntly, but let me explain. Notice that this lecture is structured in a very specific order. I'm teaching you very specific concepts in the right order. That's the order through which you must be looking at these concepts. It's not just, oh, you know what, I'm going to begin by looking at S&T and CSD and boom, there we go. No, you begin from the bigger framework. You begin by being able to become good at recognizing A to B. Recognizing inception to terminus. Once you're able to recognize inception to terminus and you're able to say, okay, price is now manipulating in this level to distribute towards the posing level next, that is when you begin looking at the lower time frame confirmations of reversals taking place. You don't just open up a chart, look for these lower time frame confirmations of a reversal and then say, okay, that's a setup. No, it's not. Why not? Because you're not following the order that I'm outlining to you right here. So please don't make that mistake, because I understand that some of you might be confused right now. You might be listening to me speak and you might be like, damn, this is a lot. Yes, it is a lot. However, once you begin to understand the logic which I'm teaching to you, you'll actually begin to see that it is a very simple process. It's a very straightforward process based upon time and price. And once you begin adhering to this process, all ambiguity behind why the markets go up and down, why they do what they do, why prices begin to expand when they begin to expand gets removed. Why? Because you're looking at time and price through an objective perspective. Time and price are the only two objective variables which we can be paying attention to. Time being represented on the x-axis and price being represented on the y-axis. Once we begin to recognize the sequences within time and price and they begin to align and they begin to tell us the same story, that's when we know that we have a high probability trade setup. If only price tells you something, it doesn't mean anything. And that's the issue with everyone that purely looks at PD arrays. They have no clue what time is telling to them. Okay, surely they might implement a specific element of time in the form of a macro or whatsoever, but a macro by itself also means nothing if it's not taking place at the end of a manipulation. Look, just because the macro window presents itself, it doesn't mean that there will be an opportunity. The opportunity gets recognized by becoming good at recognizing the delivery profile according to the time cycles. Recognizing manipulation, because once you recognize manipulation, that is when you can anticipate the macro to do a specific thing. And only then can you be looking at them. But I'm sorry for the rant in between this lecture. This is a very raw lecture, as you've probably already noticed, where instead of me going over a presentation slide, I've literally just taken you with me into a whiteboard and moving from there. When we then pay attention to some chart examples, here you can see some trades which I took the past week. I've posted these trades either within my public Telegram channel or I've posted them on YouTube. And what's important to note is that when it comes to the setups which I've taken this week, they're all based upon the same logic as I've taught it to you throughout this lecture. Now in front of you, you can see a short which I took throughout the afternoon session on the Nasdaq. And what you can see is that I shorted the Nasdaq inside of this previous 30-minute cycle low right here. Now the logic behind this trade has nothing to do with purely that previous 30-minute cycle low. There's way more to it, and that is what I'm going to walk you through it. What I would like to see is that throughout the line cycle, the market expanded towards the upside. Do you see how clearly price expanded, retraced, expanded, retraced, expanded, retraced, etc. Eventually, towards the end of the line cycle, what we saw taking place was that the market formed this BC, we saw the market retrace into that BC. We saw the market consolidate around that BC for a while before eventually 1 p.m. opened up. 1 p.m. opened up and we saw more consolidation taking place. Eventually the market repriced higher, taking out buy-side liquidity resting above the previous high. What high? The previous 90-minute cycle high right here. The line cycle high. Do you see how the market took out that high, retraced, had one more push higher with this large upclose candle, and then began to reprice towards the downside? From that moment in time, we're beginning to think to ourselves, okay, wait a minute. The market expanded towards the upside throughout the line cycle. We saw the market begin to slow down, and then all of a sudden it began to manipulate towards the upside. That right there is signaling to us, hey, the underlying order flow might begin to change soon, where we're changing from buy to sell program. What we can see is that the market repriced into the price range of this previous 30-minute cycle low, this downward candle. We saw the market find support there multiple times. Notice that every single time that the market traded into that range, it retraced into this large upclose candle where it is a bearish order block. We saw the market eventually reprice towards the downside, taking out the previous 30-minute cycle low, trading into the lower end of this BC right here. The moment that price retraced higher and I saw the signs of a smaller market maker sell model taking place, I went short inside of this retracement higher. When we pay attention to the time, what I would like to see is that the time was within the macro window from 1:45 p.m. to 2:15 p.m. I anticipated that 2 p.m. would likely distribute towards the downside heavily, and that is how you saw me outline literally big downward candles incoming right here. But what we saw take place was that the market expanded lower, and we saw it displace below this BC on the left side of the curve. Now, the moment that price displaces below imbalances which formed on the left side of the curve, we must see those imbalances function as resistance on price on the right side of the curve in order for the underlying order flow to remain bearish. What we saw take place was that the market retraced higher and that provided new shorting opportunities. Eventually, the market expanded lower and we saw a CB form right here as the market was leaving this BC's range once again. The moment that price retraced into that CB, that is IOFET taking place, institutional order flow entry drill, where the market simply taps the imbalance and then begins to expand away from it. But notice that we're now discussing details on the right side of the curve. From the moment that price takes out this line cycle high and we see the signs of reversal taking place, this becomes a inception and terminus becomes the previous 90-minute cycle low right away. A to B. It's as straightforward as that. And I hope that you're beginning to appreciate the level of simplicity within that which I'm outlining to you. Where we're simply focused on inception to terminus, A to B all the time. And that is what our focus has to be on. And only then, once that is defined, we can be looking for lower time frame confirmations of entries, etc. taking place. However, the framework is that what matters, and that is what we're discussing today. Notice that the market expanded towards the downside at 2 p.m. exactly, and we saw multiple imbalances getting created. Notice that the market stopped right in advance of that previous 90-minute cycle low, and that is something which I love to see. And the reason being is because that's the engineering of more sell-side liquidity taking place. The market retraces higher into CE of this CB which got formed, this large CB, and eventually the market expanded beautifully towards the downside, taking out the large cycle low, and that was the idea done. This was a beautiful shorting opportunity, and it is all a result of a purge of a previous 90-minute cycle high, followed by a revert towards the previous 90-minute cycle low. When we pay attention to another short which I took, I would like you to see the following. When we pay attention to the time of this short, we can see that it took place throughout the first 90-minute cycle of the New York morning session. What I would like you to see is that throughout my annotations right here, you can see that I'm very clearly paying attention to the previous 90-minute cycle high, which also was the golden high, and the previous 90-minute cycle low, which I outlined right here. 7 a.m. opens up and we see the market consolidate. It's just going back and forth, back and forth, back and forth. Eventually at 8 a.m. however, what we see taking place is that the market reprices above the previous 90-minute cycle high. Notice that we take it out by this wick right here, but notice that there isn't any real manipulation yet. The market retraces and we see the market have one more push higher, taking out this buy-side liquidity pool right here. Now from this moment in time, what we're monitoring is the reaction to the BC which formed right here. Notice that the market displaces through this BC with the creation of a CB. We see the market retrace into that. And that right there is where I want to short. And the reason being is because at 8:15 a.m. there was a high impact news release. But manipulation was already taking place from 8 a.m. Meaning from the moment 8 a.m. opened, we saw manipulation higher taking place. So what will the news release at 8:15 a.m. do? It would distribute towards the downside. Why? Because manipulation already occurred and think back to the concept which I'm outlining to you. The moment that we recognize manipulation, we can anticipate distribution to follow afterwards. So what you see is that at 8:15 AM, the market beautifully expands towards the downside, taking out the previous 90-minute cycle low. So we took out the previous 90-minute cycle high, referred towards the previous 90-minute cycle low. How do I know that the time is right for the market to draw towards the opposing side of the range? SMT. Little gem for you in there. Notice that the market retraces into the previous 90-minute cycle low after having taken it out, and the market then expands lower, drawing even lower afterwards. All in all, again, a beautiful purchase and reverse framework, but at a different time. But when you pay attention to the bottom right here, what you can see is that once again it took place between 7:45 AM to 8:15 AM. And that is where the ideal entries present themselves. The only times that I'm interested in trading outside of the macros is when it's so clear that manipulation is taking place in advance of the macro and that the macro is likely going to distribute next and the creation of key arrays is taking place. With that being said, this lecture comes to an end. I hope that you found it insightful. I know that we discussed a lot, and if you feel like your head is hurting right now, that's completely normal. That's completely fine. But keep in mind that over time, these concepts are going to be engraved in your mind. And once you begin to see this very clearly, that is when you're able to say with a great deal of confidence, hey, I understand IPTA. I understand why it's going up and down. I understand when it's going to take place. And that is a great feeling that I truly hope that you will get to feel one day. The only way for you to get to that feeling is by literally going into the charts and trying to investigate everything which I'm showing to you right here. I understand that some of you are probably not going to do that. You're probably just going to basically move away from this lecture and think to yourself, okay, now I understand it. Boom, now I can go out there and trade. No, you can't. I will never tell you to go out there and trade. I will never tell you to go out there and invest any money. I'm not a financial advisor. However, what I can promise to you that if you go out there and investigate that, what I'm showing to you, you will never be looking at the markets through the same perspective ever again. Thank you for watching this lecture all the way to the end. Please let me know in the comments if you enjoyed this raw style format of lectures, and I look forward to speaking to you soon again. Be safe.